We wanted to get this in your hands as quickly as possible since we've had it completed. And man, we're really excited to present this to you. So let me start with the end in mind, and then I'll circle back around to the beginning and kind of how we got to where we are right now. So this is a policy that, starting with the 47-year-old male, $25 million death benefit. And if we do everything right and it works out the way we have illustrated here, it will start to generate for you 15 years into the future on paper, $493,000 a year, income tax free for the rest of your life. And it goes starting at your age 62, since you're 47 now, all the way through age 120. $493,000 a year, income tax free for the rest of your life, all while also still maintaining, while taking $493,000 a year income tax free, taking a death benefit for your loved ones and your beneficiaries somewhere between $5 million on the low end up to $26 million on the high end. So it's definitely something that you should take a look at, which I know you're already interested in and excited about. But allow me to kind of go back to the beginning and set this up now that I've got your attention. We're starting with the $25 million policy, and we could do a term insurance policy for you at $25 million. And for that level at your age, a 10-year policy would be $25,000 a year. A 20-year policy would be $40,000 a year. A 30-year policy would be $81,000 a year. And remember, I did a video, you can check this out in the YouTube channel, but less than 2% of all term insurance premiums ever pay a death claim. It's because the insurance companies know how to properly structure and price out that risk. So most term insurance policies expire worthless beyond the term of 10, 20, or 30 years. And people live beyond that, and they don't continue to pay the premiums because they're exorbitantly more expensive. So our wealthy clients then look at permanent policies, and we can look at indexed universal life, we can look at variable life, and we can look at whole life options. But in these designs, if you were going to try to max fund or minimally fund the premium, that is, to maintain a $25 million death benefit, John Hancock has a policy, $290,000 a year would be the premium that needs to go in for 10 years. And that generates a 5.7% IRR. Or you could do a VUL policy, which has less guarantees and benefits to it, 5.5% IRR if we're strictly focusing on the death benefit. But when we use properly applied leverage, Archimedes said, give me a lever long enough and a fulcrum on which to place it, and I shall move the world. The reason why clients look at financing the premiums or premium finance is, one, you can earn more money on your assets than the cost of borrowing the money from the bank. Right now, we're looking at a cost of borrowing the money from the bank of about 5.5%. So you're really good at making money, you're really good at earning money on your money, as almost all of our clients are. And so that's one of the arbitrages. Let's let the bank finance the premium so you don't have to divest it from where your money is currently working hard for you. Second arbitrage is that inside of the policy, the index crediting method historically has outperformed the cost of borrowing the funds. And we see no reason for that to stop. In fact, I did a video on that as well. I can put the link when I send this over to you, or the link is in the description. The video describes the relationship, the historical relationship between index crediting method of the policies and the historical borrowing rate, and how that's been in our favor for quite some time. The third arbitrage is that the premiums that you're borrowing from the bank, these are tax-free premiums because it's in the form of a loan. If you were going to pay these premiums, and remember I said if you did a self-pay option, $290,000 to $315,000 a year, if you were going to pay those premiums, you have to pay those premiums in a way where you have to earn the money, pay the tax to then pay the premium. But when we finance it from the bank, those are tax-free premiums. And the fourth and final arbitrage is that the gross death benefit, which I'm going to show you here in a second, is always in excess of the loan balance. Right? So we have four arbitrages which give premium finance a compelling story. Now, it's not a requirement. If you want to do a self-pay model, we're very happy to help facilitate that for you. But the power of leverage in premium finance is you can borrow at lower rates, you can maximize your liquidity, and you achieve financial efficiency. And so when we go back to that design and we look at premium finance as a model of financing the premiums, assuming you paid 20% of the premium, which I'll discuss here in a second, you're looking at a 7.2% IRR at age 90, where the traditional models are in the 5.5 to 5.7% IRR return. So here's what the death benefit only design looks like. Again, columns 3, 4, 5, 6, and 7 are life insurance policy information. For a gentleman your age at your health rating for a $25 million policy, the suggested maximum premium is $1.7 million a year for 10 years. We are going to get a bank to lend you those premiums based on your credit and your personal financial statement. They're going to loan you those dollars. And by loaning you those dollars, we're able to get maximum cash value into the policy. So column 5 is the policy value. Column 6 is what we call the cash surrender value. And that's the portion of the policy that the lender takes as collateral. And that's what we're going to focus on right here, the cash surrender value, compared to the outstanding loan balance. Now, the policy premium of $1.7 million a year on a $25 million policy. And all of this is adjustable. We just did this based on the information you sent. We can adjust the death benefit up or down. We can adjust the premiums up and down accordingly. But assuming we did this design, the bank is going to finance the premiums. And the bank lending information are columns 8, 9, 10, 11, 12, 13. We show you paying 20% of the amount that the bank is lending you out of pocket for 10 years. Now, this column 12 is not a requirement. It is a suggestion. If you want to pay less out of pocket, totally fine. We're just going to have to cover a potential shortfall of collateral in column 14. What the bank is really looking for is they're looking for the outstanding loan balance that they've provided you, loan of the premium, plus any interest that they're charging, minus any payments you make out of pocket equals the outstanding loan balance. And we can do this with some of our lenders at no personal guarantee, non-recourse. They're going to subtract the outstanding loan balance from the cash surrender value. So in year one, 1.53 of outstanding loan balance versus 1.51 of cash surrender value. It's an $18,000 difference based on these projections, these numbers. And assuming you paid $350,000 a year every year for 10 years, your peak collateral is $47,000, less than the watch you're probably wearing on your wrist right now. $47,000. And then at that point, there's no additional collateral required because cash surrender value, column 6, maintains a higher value than the outstanding loan balance. So the bank is fully collateralized by the cash value in the policy. We then show an exit coming out in year 14. That exit is not a requirement. We're just showing it to show that you can have a plan to exit the loan. And in this example, remember, death benefit only, maintaining a strong 20 plus, $25 million plus, getting into the $30 million death benefit for your loved ones. Now that's the death benefit only design. And as I mentioned earlier, what may be interest to you, I don't know, is the tax-free distribution design. So everything's the same, except once we pay the loan off in 14th year in this example, we then start to take tax-free distributions from the structure. And that's where the $493,000 a year income tax-free comes out. And you can see what that does to the outstanding loan balance. So this is a starting point for the design. I hope you found it interesting. We can adjust the outstanding payments you make in column 12. We can adjust the size of the death benefit. You probably have a capacity where we can get even higher than the 25 million. We might be able to stack some term insurance on top of this design, another 5, 10, $15 million of term insurance to give you some insurance capacity that we can draw upon in later years to then do another design. But this is the starting point. This is why we're so excited. Let's get into underwriting. Let's discuss such questions and let's tighten this structure up for you as we move forward.